Welcome to The Explainer. In today's briefing, we're cutting right to the chase on AI in credit risk. This is the strategic landscape that financial leaders, that you need to know to navigate the disruption that's already here.
So let's just start with the sheer scale of this whole transformation. $356.2 billion. That's the digital lending market in the US for this year alone. It's a market being completely rebuilt from the ground up by artificial intelligence.
For anyone in an executive role, the conversation has totally changed. It's not about if you should adopt AI anymore. The real question is how you're going to harness it to get a real competitive edge, all while managing a whole new world of risk.
All right, here's our game plan. We're going to start with the new reality of credit assessment, then look at the promise of better accuracy and inclusion. After that, we'll get into the really critical stuff, the new risks around bias and compliance. Then we'll see who's winning the adoption race, and we'll wrap up with a playbook for building your own AI framework.
Okay, first up, the new credit landscape. Traditional credit models are facing their biggest shakeup in decades, and it's absolutely crucial to understand why this is all happening right now.
Think about it this way. The old world, it was like looking at a single old photograph, a static FICO score. But the new world of AI, it's dynamic. It's like watching a live video. It processes huge amounts of data, both the usual stuff and all this alternative data, to create a living, breathing, real-time picture of someone's creditworthiness.
So what's the big payoff here? Why go through all this trouble? Well, this isn't just about cool new tech. AI delivers real, tangible benefits in two areas that matter most: accuracy and financial inclusion.
And this is where it gets really interesting, because we've got the hard data on why this works so well. Just look at the predictive lift. Bringing in bank transaction data can make your model almost 13% more accurate. Things like utility and rent payments, which old models just ignored, give you a huge boost. This is how AI is finding good customers that were basically invisible before.
And here's what that looks like in the real world. This is the impact on people. After putting AI in place, approval rates for recent immigrants shot up by 132%. For young adults, a 67% jump. This isn't just a theory. AI is turning financial inclusion from a nice idea into a measurable business outcome.
Okay, and this is a big but, all this incredible power comes with some serious new risks. This is exactly where leaders need to be focused, on navigating bias on one hand and the maze of regulatory compliance on the other.
This right here, this is the question that's keeping risk and compliance officers up at night. Regulations like the Equal Credit Opportunity Act demand that you explain why you denied a loan. But when that decision comes out of a super complex neural network, how do you give a clear, justifiable reason? This black box problem is a massive compliance hurdle.
So you can't just flip a switch on an algorithm and hope for the best. That's a recipe for disaster. Managing this risk requires a really robust framework. It means embedding fairness checks, continuous bias testing, and compliance feedback loops right into the system, from the moment the data comes in to the final decision.
The good news, though, is that we're not flying blind here. We have a growing toolkit to deal with this. Mitigating bias isn't just one thing. It's a whole process. You can start before you even build the model by cleaning up the data. You can do it during training by adding fairness rules, and you can even do it after by adjusting the results to make sure they're equitable.
So we've weighed the opportunity against the risk. Now let's talk about the clock that's ticking. Because while you're planning your strategy, your competitors are already moving. The adoption race is on. Wow. Just look at this gap. If this isn't a wake-up call, I don't know what is. Fintechs are at 95% adoption. They're basically all in. Meanwhile, credit unions are way behind at just 41%. This isn't just a tech gap, it's a competitive chasm that's getting wider by the day.
And this table, this explains why that gap is so dangerous. It all comes down to the return on investment. Fintechs, with their laser focus, were seeing a return in just a year. Large banks, not far behind at 18 months. But for the slower movers, like many credit unions, that timeline stretches to 2.5 years. Speed to market here is directly tied to faster returns and a stronger position.
So this brings us to the most important part. What do you actually do about all this? How do you build an AI framework that grabs the opportunity but still manages the risk? How do you innovate responsibly?
A winning strategy really comes down to 5 key things. First, you've got to build what you could call a digital factory of AI agents. Second, you have to empower the right people, get your credit experts and your tech teams working together. Third, invest in the right tech. Scalable and modular is key. Fourth, get obsessive about data quality. And finally, you have to build a dedicated risk management framework just for AI.
And if you want to see what this looks like at scale, you just have to look at what JP Morgan is doing with its Omni AI platform. Their strategy is basically a masterclass. They standardize the foundation, they embed governance right from the start, and they make it easy for teams to go from a small test to a full-blown system. It's proof that you can have both speed and control. So when it's all said and done, it boils down to this single question for every leader listening. The world of lending has been changed forever by AI. The only question now is whether your institution is going to be one of the architects of that future or one that's forced to react to a reality built by everyone else.